Welcome to the Retirement Made Easy podcast, a show created to be your go-to source for straightforward retirement advice. Best of all, it is presented in a language that you can understand. Here's your host, Certified Financial Planner, Greg Gonzalez.
Hey, welcome to the Retirement Made Easy podcast. I'm Greg Gonzalez. Thanks for joining me today. Today's episode is by listener request. Been getting a lot of questions about HSAs, which are health savings accounts, and I will always try to not use the acronym. I will always try to spell that out if somebody's not familiar with, okay, what exactly is an HSA or an RMD, which is required minimum distribution, to avoid confusing, you as the listener of all these different acronyms that are out there. And I think in retirement planning, we get enough of those with IRA. QCD is another one we hear frequently. That's qualified charitable distribution. And sometimes I think speakers can do a better job of explaining what an acronym is so everybody understands. So HSAs, health savings accounts, why and how they're useful to you if you have the ability to save in them, not only today, but in the future, and what they can really, really mean. There's a lot of rules that if you're contributing to an HSA, you really need to know about. So we're going to spend some time talking about HSAs, health savings accounts, why they're useful, why they're so attractive to people, and they become so popular. And I think they're really misunderstood and underutilized, really. We're also going to talk about some Social Security questions that have been submitted. I really enjoy getting Social Security questions because, again, it's one of those topics that people will say, well, I've heard fill in the blank about Social Security. And I would say more times than not, someone was misled about the rules of Social Security and how they work. So I'm going to go through these lists of questions, and I would be very surprised if you as the listener does not learn a few things about Social Security, maybe some things you didn't know about, and you can get a better understanding of how Social Security will benefit you in the future. And to make the most of Social Security, you really got to understand how it operates, the different factors that contribute to it, because it is a lifetime income. And I always think the better informed you are, the more informed you are, it just puts yourself in a better situation to make better, more informed decisions once you understand the ins and outs of how the system actually works. We probably don't talk about Social Security enough on this podcast, so I hope this discussion will help change that. Social Security, it is an annuity, which is just a lifetime. I know a lot of people don't like the word annuity, but by definition, your Social Security benefit is an annuity. It is a lifetime stream of income. And it even has a whopping $255 death benefit that is paid out to surviving spouse or heirs. So today's discussion is going to be very useful. We're going to dive into HSAs first, health savings accounts. Maybe you already have one accessible to you. Maybe you're not maxing that out. And maybe this might encourage you to look and dig deeper and say, hey, maybe I should be putting more resources towards that HSA for future use, knowing that it might be a bigger benefit to me down the road. Some of you might not have an HSA available to you. You might have something called an FSA, Flexible Spending Account. We will talk about how that compares to an HSA. And then we'll end this episode talking about all these different questions that we get submitted in regards to Social Security planning, Social Security benefits, when to claim, how the benefits work, what factors contribute to how much your benefit will actually be. Oftentimes I find that because people don't understand Social Security and how it works, I find that it leads to disappointment. It leads to improper planning because they're thinking they're going to get more money than they actually get. Or they left money on the table because their timing was bad, because they thought it worked this way and we were wrong. And now we're needing to replace the income that we thought we were getting from Social Security from another source. And oftentimes that miscalculation can really lead to problems. So we're going to talk about Social Security, the questions that we have. We got a list of them. We're going to go through all of them. And hopefully you will leave today with a better understanding of HSAs and the power of them, but probably more importantly, a better understanding of Social Security and all the questions that people have about them. And you'll be in a better position with a better understanding of how Social Security works. And before we get started, if you're a new listener, I welcome you to visit our website, retirestrongfa.com. There's a link in the show notes. You don't need to write that down if you're driving or something. A link in the show notes. While you're there, I invite you to download our free retirement planning resources, like our 2026 tax planning guide, my retirement secret sauce. Our Social Security planning guide is on there. It's all free. We don't ask for your phone number. We don't want your date of birth. We don't need to know your favorite color. We need your email address, and it just gets emailed to you, and we don't hound you or spam you or any of that. Our website, again, retirestrongfa.com. And while you're there, you can always submit your questions to the podcast, like so many listeners have done. And if you're one of those people that is shopping and interviewing retirement planners, I invite you to click the button on our website, the red button that says Get Started. You simply fill out the form, tell us a little bit about yourself, and then you have a phone call with Cheryl. And during that phone call, she'll see if we're going to be a good fit to work with you and help you plan for a successful retirement as a partner. And if we're not going to be a good fit, she can point you in another direction. Okay, let's get started. Today's episode, we wanted to talk about HSAs, health savings accounts. And depending on your health insurance through work, you may or may not have access to contribute to an HSA. So check your coverage, see if you're able to contribute to an HSA, and see if it's something you could take advantage of. So there is a limit. You can't put $1 million a year into one of these things. There is contribution limits for 2026 of $4,400 for self-only coverage and a family coverage of $8,750. There is a 55 or older catch-up of an additional $1,000. Now, what's interesting is why they make the catch-up age 55 for an HSA when the catch-up for a 401k starts at age 50. Why would they not align? It blows my mind why these lawmakers come up with this stuff, but it should be. The catch-up should start at age 50, just like the 401k, in my opinion, to keep it consistent. But again, the HSA catch-up starts at age 55. Now, when you contribute to an HSA, the beautiful thing about it is it's a tax-deductible contribution. So that's great. So the money going in, you get a tax deduction on that contribution to your HSA. And then while the money is in the HSA, it grows tax-free. Now, oftentimes they'll make you keep a portion like $1,000 or a certain amount in the very conservative, maybe it's a money market or cash reserve within the HSA, but most oftentimes the bulk of the HSA account you can invest in mutual funds based on your appetite for risk, your risk tolerance, and you get to pick. You just like a 401k, you get to make those decisions. Now, with the ability, the potential to grow tax-free within the HSA, that's huge. I mean, that it grows tax-free just like a Roth IRA would. And then as you begin to take withdrawals out of the HSA, as long as they're used for qualified medical expenses, the withdrawals are tax-free. So from a tax standpoint, you got a tax deduction on the contribution on the way in. It grew tax-free while the money was invested in the HSA. And then when you go to withdraw it, it's all tax-free as long as it's used for qualified medical expenses. So it's even really better than a Roth IRA because you don't get the tax deduction on the way in when you contribute to a Roth IRA. The other advantage that an HSA has, just like a Roth IRA, is there are no mandatory distributions from that HSA. Just like your Roth IRA, they never force you to take distributions. The same applies to your HSA. There's no forced distributions from that account. Now, one question that we get here and there is moving money from an IRA, individual retirement account, into an HSA. And yes, you have one time in your life to do this. You want to check the rules to make sure you're doing it properly. So we would advise you to consult with your tax advisor and your financial planner to make sure you're doing it correctly. But yes, there is a one-time exception where you can move money from an IRA into your HSA. Now, before you're 65, if you wanted to access the HSA before you're 65, for non-medical expenses, there's a 20% penalty. So that's a steep penalty. So if you're going to contribute really to an HSA, those funds in your mind, you got to have them earmarked for medical expenses in the future. Now, once you turn 65, if you wanted to pull out money from your HSA and use the funds for non-medical expenses, you would just pay taxes on the amount of money that you're withdrawing as a taxable distribution, very similar as if you withdrew it from an IRA or a 401k. But if it's a qualified medical expense, which most people, that's why they're withdrawing the money, again, it's completely tax-free. Now notice, for an IRA 401k, it's age 59 and a half, where there's a 10% early withdrawal penalty. HSA, the 59 and a half rule doesn't apply. It's age 65. Again, the similarities from rules for IRAs and HSAs are not in line. So you've got to kind of understand the rules for HSAs versus IRAs and Roth IRAs and so on and so forth. Because they're not consistent, in my opinion, it would be a lot easier if there was some consistency with these different types of accounts, but unfortunately there's not. Another benefit of HSAs, if your contributions are made through payroll deductions, is that they will not be subject to Social Security or Medicare taxes. Now, some employers will have an HSA contribution. Typically, we'll see $500 or $1,000, depending on the company. But, that's a nice perk if the company's contributing to your HSA. Now, one thing that I've heard from many, many people that have HSAs, they'll say, well, gosh, will I ever use that money? And I mean, just think about the potential of an HSA. It's going to grow tax-free and has the potential, if it's invested properly over time, over a long time horizon. And medical expenses are going to be one of your biggest expenses in retirement, I can assure you, between deductibles and co-pays and maybe prescription drug costs. Our retired clients are always talking about the costs of dental work or vision appointments. HSAs can all be used for all those expenses. In 2026, there's a Medicare Part B deductible. It's an annual deductible. It's $283. So every year you could use your HSA to help pay for that Medicare Part B deductible, which, by the way, seems to go up year in and year out. And that's something you can probably count on to continue. And I was reading a study. It was the 2025 Fidelity Retiree Healthcare Cost Estimate study. A 65-year-old individual may need $172,500 in after-tax savings to cover healthcare expenses in retirement. Boy, an HSA could really, really help out with that. And we have several clients that are utilizing HSAs and earmarking the funds they have invested in HSAs for long-term care expenses or part of their expected long-term care expenses in the future. Guess what? Long-term care expenses, those are medical costs. You better believe it. That is a qualified medical cost. And a lot of people will earmark HSAs for the health insurance coverage before 65. So let's say somebody retires at 62 and chooses not to go on COBRA and utilize COBRA coverage, so they get health insurance outside, and they can use that HSA to help pay for those premiums, which can be quite expensive, as we know. Now, you want to be careful because once you turn 65, let's say you get a Medigap or a supplement plan, you're not allowed to use the HSA to pay your Medigap or supplement premiums, like the monthly premiums. But there's a lot of other expenses that it can help pay for, like we talked about, those deductibles and copays and those kinds of expenses, prescription drug costs. And another important point, if you're married and you have your spouse as the beneficiary on your HSA, your HSA would pass to them upon your death, and it would essentially become your widow or widower's HSA plan. And it would, of course, continue with the same tax advantages. So for those folks that are married, that maybe they have an HSA in one spouse's name, something happens to that spouse, it's a great way to help protect the surviving spouse and continue the benefits that an HSA offers. And by that, I mean the tax-free growth potential and no required minimum distributions from HSAs. So for those people, again, retiring before Medicare age of 65, HSAs are extremely common, they're extremely useful, and it might be a good idea as you're looking at your retirement plan to say, okay, those first few years of retirement, it's going to cost us quite a bit to have that healthcare coverage. How are we going to pay for that? And maybe it's a good idea to start funding an HSA so those funds are earmarked. You might have other methods, you might have other insurance coverage you're looking at, but it's probably a good idea to start at least considering an HSA for that coverage, for those costs. So if it's available to you, or maybe one spouse has an HSA that's available from their work and the other spouse does not. Maybe that's something one spouse can take advantage of. Now, one more thing, we're going to talk about flexible spending accounts, FSA. Not the same thing as an HSA, health savings account. A lot of people, when they hear FSA, they think use it or lose it. And that's something you got to keep in mind. Is an FSA, flexible spending account, is it worth contributing to? I had a client not too long ago say at the end of the year, what they do is they go to the drugstore and they use what's left in their FSA flexible spending account on Band-Aids and Tylenol and things like that they might use, because it's use it or lose it. Those funds go away if they don't spend them by the end of the year. So, in my opinion, you probably don't want a whole lot left over towards the end of the year if you don't want to lose the funds in your FSA. But it's good to know that they're different. They are different types of accounts. And when I'm talking about an HSA, I'm not talking about an FSA. They are totally two different animals. Just like the after-tax 401k is not the same thing as a Roth 401k. Over the past couple of years, we have met plenty of folks that they are under the impression that an after-tax 401k means it's a Roth and it's growing tax-free. And you want to be very, very careful because they're totally different. And by making that mistake and assuming they are the same type of account, you can really, really cost yourself some extra taxes that you could have avoided if your funds were in a Roth 401k like you thought they were. Maybe I'll do a podcast on that. Maybe I'll do it. It's really a case study where we saw an individual that cost themselves tens of thousands of dollars in taxes because they made that mistake and thought their funds were in a Roth 401k, whereas they were in fact in an after-tax 401k. And those are two separate, different types of accounts. And the taxes that are paid on those two accounts are totally different. All right, let's jump to some Social Security questions here. First off, people seem to have questions about their Social Security statements, and you've got to remember that these Social Security statements, the figures that are on them, like, what your predicted amount is that you would receive at age 62 all the way through age 70, these are estimates. And these figures are not accurate. Let me explain why. If you, hypothetically, let's say you retired at 62, but you're looking at your Social Security statement and you're saying, gosh, I'm going to wait until 70 when it's maximized, you might not get that amount that is reflected on your Social Security statement, because the Social Security statement, and it does say in the fine print, it's assuming that, like when you're looking at the age 70 benefit, that's assuming you work at the same capacity you're working now through age 70 and collect at that time. Just like the benefit at maybe full retirement age, let's say you're only 60 today, and your full retirement age is 67, that's assuming that you work until you're 67, claim the benefit at your full retirement age once you retire. So it is making some assumptions there that you continue to work at the pace you're working currently until that age, and you continue to pay into Social Security. Now, that said, let's say you retired early and you retired at 61, and then you had a full year where you didn't have any earned income, like a W-2 income or 1099 income from employment, then Social Security would take it a full cycle. They would report, okay, you made zero earnings of earned income in 2026. So then on the next statement, it would say, okay, it would assume that you continue to be retired, and those figures, those monthly amounts of Social Security benefits would then update now that the system says, okay, this person's now retired. So it would assume that you continue to be retired until you claim at those future ages. Now, the other thing that Social Security benefit statements don't include is any cost of living adjustments. So like thinking back a couple of years ago when we had near record inflation, there were some above average cost of living adjustments to Social Security, and that really did impact people's Social Security benefits because the estimate statements did not factor those big cost of living adjustments in. So keep that in mind. They're not perfect. They do not include your Medicare Part B premium coming out of them. So let's say you hop on Medicare at 65, and you're collecting your Social Security benefit. At a minimum, your Medicare Part B premium, which in 2026 is $202.90 per month, and it could be higher based on your earnings a couple of years ago. We'll get into that here in a minute, believe me, but call it $203 per month. When you look at your Social Security statement, it does not say, oh, by the way, it doesn't even factor in that you're not going to receive that amount on your Social Security statement if you're on Medicare, because that Medicare Part B premium would come out of that Social Security benefit. So what happens is people say, gosh, I thought I was going to get more every month. Well, it's because your Medicare Part B premium of $203 a month came out first, and then you're left with the rest. And I know this may be obvious as well, but that amount that's reported on the Social Security estimate statement, that's a gross figure, obviously. So they're not assuming that taxes are withheld whatsoever. But in reality, you might decide to withhold federal income taxes from your Social Security benefit check. We get a ton of questions about IRMAA surcharges and how that impacts people. And really, if this is totally new to you, you haven't heard of it before, that's totally okay. But basically, like if you're getting on Medicare this year in 2026 and you're turning 65, what they'll do is they'll actually look at the income from 2024. They'll look at your modified adjusted gross income, and that will dictate how much of a Medicare Part B premium that you're going to pay. And you might have some surcharges because your income 2 years ago was above a certain amount. And there is a table, we'll link it in the show notes, the IRMAA brackets. And so based on your filing status and your modified adjusted gross income 2 years ago, that will impact what you pay today. Now, what a lot of people don't know is, let's say your income was above those thresholds because you were a high income individual, had a high salary and bonuses and all that kind of stuff. Maybe your spouse was as well. That earnings 2 years ago in 2024 is going to dictate how much you pay today in 2026, 2 years later. But you can let Social Security know that you had a change of life event, and that can help. They can basically give you an exception, and that can reduce how much you pay into Medicare, and that can kind of wipe out those IRMAA surcharges. But you've got to fill out a form and submit that to Social Security, and that form is called the SSA 44 form. And, in that scenario, you would say, hey, I retired. I'm in a lower income environment now that I've stopped working. And the reason for my higher income 2 years ago in 2024 was I was still working, and I'm just in a different season now that I've retired. And they will ask you to estimate your income for 2026. Now, in our experience at Retire Strong, most of the time those do get approved. And that's a great way to save yourself money on the IRMAA surcharges. So just because your income was higher a couple of years ago, there is a way to get out of it, so to speak, with this exception, this form, this SSA 44 form. I always say file it, ask for it, because the worst thing they can do is turn you down, and then you're right back to where you were. The best thing that can happen is they can approve you, and then that can save you literally hundreds of dollars every month in that IRMAA surcharge. So again, there'll be a link in the show notes where you can read more about this IRMAA surcharge. And again, they look back. So then in 2027, for example, that would be based on your income, modified adjusted gross income in 2025. So it's always 2 years. There's a 2 years difference. What you pay in this year is based on your income and what it was 2 years ago. So it is a year by year penalty or surcharge that you pay, and you might pay more this year, but next year it might go down and the IRMAA surcharge might go away. The other thing is, we've had podcast listeners that have reached out and said they want to do these mega Roth conversions. So in other words, they're doing Roth conversions of hundreds of thousands of dollars. And one of the things that I'll always point out is if you're on Medicare, that might really drive up your income. And 2 years from now, you might have big IRMAA surcharges, and your Medicare Part B premium with the IRMAA surcharge, it might be $600, $500, or $600. So keep that in mind, that there's an extra cost that people don't think about. It might cause you to pay more in capital gains taxes than you would have otherwise. You might pay more on your Social Security benefit because you decided to do this big Roth conversion. So there's always a cause and effect. Now, another thing that has come up is when you start your Social Security check and claim that benefit, they're always a month behind. So if you're 62, if you turn 62 in February, for example, depending on when your birthday is, you're not actually going to get your first check until March at the earliest. And depending on when your birthday falls, there's a good chance it's not going to be until April when you would actually get your first Social Security benefit check. And you might say, well, I turned 62 in February. That's not fair. I agree with you. It's just that's how the system works. They're a month behind and could be 2 months behind depending on your birthday. So I think a lot of people are surprised by this. They expect, hey, in the month I turn 62 or I turn 67, that's when I would actually get that check. Again, Social Security is a couple months behind here, 1 to 2 months behind. It doesn't make sense the way they do it, in my opinion. In other words, if you're 67 and you say in March, and you say, okay, I'm going to claim my benefit when I turn 67, well, you're not going to actually get your first check until you're 67 in 1 month or 67 in 2 months. So you would actually want to claim it to start the month prior to when you turn 67. So when you go to file, you will actually get to pick the month you want it to start. But again, the first check is not going to be received until either the next month after that or the following month. So keep that in mind. I'm just trying to save you some disappointment here, because when people go to select that date that they're going to claim their benefit, start their benefit, you would anticipate that, okay, you're going to get your first check in the month that you pick. And again, that is not how it works. They're a month or two behind, depending on when your birthday falls. It's kind of messed up. I don't know why they do it that way, but just kind of passing on information. Now, if you claim your benefit before your full retirement age, they're going to ask you when you file how much you plan on making that year. So let's say that you file your benefit, you're 64 years old, and I'm just making up as I go, but just this is my example, so bear with me. Let's say you're 64 years old, you file in June, and that means you would get your first benefit check in July or August, depending on your birthday. And let's say you made, so far through June when you retire, you've made $50,000. And there's a lot of people that would say, well, that's well above that limit of $24,480 in 2026 that you can make. And you've probably heard for every $2 above that limit, they're going to withhold $1 of your Social Security benefit. But the earnings that you made, that $50,000 before you started your Social Security benefit, they don't count. They're talking about the money once you claim your benefit and you're retired. So they're looking at, okay, July through December, how much do you plan on making? If you said, hey, I'm done, I'm going to be fully retired, I'm not going to have any earned income the rest of the year, any employment income, then you would tell them zero. That $50,000 that you made through June, the first part of the year, will not impact the Social Security benefits that you received, the second half of the year, because you're not working while you're collecting your Social Security benefit. You were working before you started your benefit that first half of the year, first 6 months of the year. So I hope that makes sense. It's a big point that a lot of people get confused. But if you did plan on working, let's say you said, hey, I'm gonna make $30,000, the second half of the year, then they're going to withhold money from your Social Security check, and it might be a better idea to wait to claim your benefit. We have had more people confused over this very topic, and I totally understand why, because it's messy. And depending on who you talk to at Social Security, you might get a different answer. And the other thing, a question that goes right, hand in hand with this is your spouse's income does not go towards that limit. So in this example, for this person that claimed their benefit, if their spouse was making $100,000 and still working, that would not impact their Social Security, the other spouse's Social Security benefit. When you go to claim, they're going to ask you, how much do you plan on making while you're collecting your Social Security benefit? They're not asking about your spouse. Even if you file married filing jointly, they're asking about you, not your household income. So keep that in mind. And that's another point that a lot of people make mistakes there and tell Social Security their household income instead of what they plan on making, and they get themselves into a mess. One question that we had was in regards to Social Security disability benefits. This person was receiving Social Security disability benefits and had inherited a large sum of money. We're talking north of $1 million. And there was a beneficiary IRA in there. There was a brokerage account, and they were concerned that that would impact what they were receiving from Social Security disability. And the fact of the matter is that inheritance will not impact your Social Security disability benefit whatsoever. It is only based on one's ability to work. So good news there. The next question that we had, and we've heard this on occasion, is when it comes to a survivor benefit. So a scenario is, let's say the wife is 62 years old, her spouse was 68 years old and passed away. And the 68-year-old spouse was receiving their Social Security benefit when they passed. So at that point, what does the 62-year-old surviving widow do? She doesn't have to do anything. If she wants to delay her own benefit, she's only 62, she can also delay her survivor benefit. So it really kind of depends about her situation. Is she still working at 62? Because those earning limits would apply to her at 62. Again, we went over that. It was $24,480 per year. And for every $2 she would earn above that, they would reduce $1 of her Social Security benefit, and that would apply to her survivor benefit. So what she could look at, though, is to say, okay, if I claim my survivor benefit now at age 62, she would get a little over 80% of what her spouse was receiving, and that would be her survivor benefit. Now, if she waited another year until 63, it'd be a little over 84%. Waited until 64, it'd be 88.6%. All the way until her full retirement age, her survivor benefit would be 100% of her spouse's benefit. That's when her survivor benefit would max out. Now, what she might do, and again, this all depends on her situation, what her spouse was receiving, what her benefit looks like. But what some people decide to do is, especially if she's already retired at 62, she could claim her survivor benefit. So she's getting some Social Security income. And then as long as her own benefit later on down the road at age 70 is greater than her survivor benefit, she could switch over to her own benefit at 70 once it was maximized. So let's say she gets her survivor benefit now and it's $2,000 a month. Her own benefit at 70 years old would be, might be $3,200 a month. So she could collect her survivor benefit now for the next 8 years and then switch over to a higher benefit, her own benefit, in the future. So these survivor benefits, when you're dealing with somebody's own benefit and then a survivor benefit, there is some strategy and a thought process that goes into it to maximize your Social Security benefits. Now, Social Security is not going to give advice. They're not going to say, oh, we'll run different scenarios to maximize this for you. They're just there to accept your instructions and kind of help you in that regard, but they're not there to give you advice. So you have to set your expectations of, hey, I'm not going to get a financial planner when I go to the Social Security office. And in my experience, I can't tell you how many people just missed an opportunity because they just didn't know, hey, I can start my survivor benefit and then switch over to my own down the road, and it's going to delay at 8% per year between full retirement age and 70. And this is a way that I can collect the survivor benefit and then get a higher benefit and reward myself on my own higher benefit down the road. Now, to make matters even more complicated, if you were married and have an ex-spouse and were married to that individual more than 10 years and did not get remarried until you were 60 or over, you would still be eligible for spousal benefits and survivor benefits. So we have actually had where somebody is divorced and their ex-spouse unexpectedly passes away, and then there's a survivor benefit. Just like they were still married today, that survivor benefit would come into play, and that impacts their planning. Now, we don't want to wish ill will on anybody, but depending on their lifetime earnings and how much they paid into Social Security, this could really, really benefit someone or even multiple people, depending on how many people they were married to. So think about it like that. The survivor benefit would be on the table maybe to their current spouse, but maybe to multiple ex-spouses as well. And if you don't believe me, look at Johnny Carson. He passed away a number of years ago, but 3 out of 4 of his ex-wives, he was married to 10 years or longer. So when he passed away, they were eligible for survivor benefits. And while he was living, they had the potential for spousal Social Security benefits based on his earnings record. Now, I understand you don't meet too many people that have been married that many times, but it is possible. That's all I'm saying. Another question that we got, this is kind of a little unusual, but it's worth talking about, is if you're a U.S. citizen, you're receiving Social Security benefit income, but you're living abroad, is that possible? Actually, on SSA.gov, on the Social Security website, there's a list of countries where they will allow you to live and send money. And it says if you are a citizen of one of the countries listed below, your Social Security benefit payments will keep coming no matter how long you stay outside the U.S., as long as you are eligible for payments. Now, there are a list of countries to which Social Security is not allowed to send payments. So just by eyeballing this, there's probably about 30 countries where they will allow you to live and send payments to. So we'll try to include a link in the show notes if you're interested in this. This person actually had or knew someone that was moving to Portugal, and that was one of the approved countries. The next question is somebody was 68 and they planned on starting their Social Security benefit at 68 and a half, which is 6 months later. And their Social Security statement said that they would get no benefit, no higher benefit by waiting those 6 months, and wanted to know if that's correct. And that's not correct. So for every month that you wait between full retirement age and age 70, you will get an 8% annual credit. So if this person is going to wait 6 months, you would get a 4% higher benefit. It's called a delayed retirement credit, and it amounts to 8%, and it's simple interest. So 8%, 8%, 8% would be a 24% higher benefit at age 70 than if your full retirement age was age 67. Now, that doesn't include cost of living. So cost of living could end up making your Social Security benefit by waiting even greater. So keep that in mind. Now, the other thing is, if this person hypothetically just said, oh gosh, I'm 68 and a half, I wish I would have claimed my benefit at age 68. I'd like to go back in time. There is a one-time opportunity to do that. If you're past your full retirement age, you can go to Social Security benefit and claim that a retroactive payment, and they will pay you for the last 6 months as sort of a lump sum. And then your Social Security benefit would be as if you claimed at age 68 instead of 68 and a half. So that is a possibility for anybody past full retirement age. Somebody would ask, why would anybody do that? Let's say you need the money and you're past full retirement age and you had a crisis. That, again, it's an option for you. It might not be the best option. Let's say you had a sudden unfortunate health event and it shortened your life expectancy. Well, that might be a good idea to do something like that. It's not for everybody, but it's good to know that it's an option. It's good to always know your different options and the choices that you have. And just looking at the time, it's been a longer episode. Thanks to all who have bared with me throughout this episode. There's one more question here. This question for a couple where typically you need to qualify for Social Security, you need 40 quarters or 10 years, roughly 10 years of earnings history to qualify for your own benefit. So you get up to 4 credits a year. And in 2026, the earnings credit, the amount of money that you need to make to earn 1 credit is $1,890. So if you take that times 4, that is $7,560. And let's say, hypothetically, that you earned $7,560 just in the first 3 months of the year. Well, that would give you 4 credits. You don't have to space that $1,890 per quarter to qualify for each credit. You can make it all up just in the first quarter. If you wanted to make $7,560, that would give you 4 credits. Now, the dollar amount of the credit does go up over time. You can imagine like 40 years ago, It was not $1,890 per credit. Just last year in 2025, it went up from $1,810 per credit to $1,890 per credit in 2026, just to give you an idea. So you really do need those 40 credits. Again, it's about 10 years worth of work to qualify for your own Social Security benefit, and they're based on your best 35 earning years, and not necessarily by dollar amount, because those earning years are indexed for inflation. So for example, in 2026, the cap that you're going to pay into Social Security with your payroll tax is up to the first $184,500 that you make. That income cap was much, much lower, maybe when you started working 35 years ago. And because I have a curious mind, I actually looked that up. In 1991, the earnings cap for Social Security was $53,400 per year. So meaning you paid into Social Security on the first $53,400 that you made. So even though that maybe you were at that cap back in 1991, that maybe you're nowhere near $184,000 today, the new earnings cap, those years back then where you were at the earnings cap in 91 or in the 90s actually helped you more from a Social Security standpoint, give you a better benefit than maybe what you're earning today. And obviously gaps in the last 35 years, like if you had a couple of years out of the workforce because you were raising children, or maybe you were just taking time off, maybe a year in which you experienced a layoff, something like that. Those years that you might have lower or even a goose egg as far as earnings, it's not a rolling 35-year. It's your best 35 years that you've ever earned or paid into Social Security throughout your lifetime. So those goose eggs, yes, they might impact you, but they might not if you had other years that replace them. But if you don't have the 40 credits, you don't have 10 years of earnings history that you've paid into Social Security, and you don't qualify for your own Social Security benefit, let's say you were a homemaker, or what one of our clients calls a domestic engineer. So a lot of people would say, okay, she doesn't get a Social Security benefit. Hold the phone here. Now, she is eligible, even though she doesn't qualify for her own Social Security benefit based on her own 40 credits, she does still she's entitled to a spousal benefit, which is up to 50% of her spouse's benefit at full retirement age. So she might have to wait until she's 67 years old to get the most, but she could get the spousal benefit up to, it would be maxed out at 50% of her spouse's benefit at full retirement age. And I find that is news to some people, especially, we have some clients that say, well, I stayed home, I raised the kids, my earnings history, my Social Security benefit is very low. It's just a couple $100 a month. Keep that in mind, that your spousal benefit may be much, much higher. And the fact that your benefit is just a couple $100 a month or is below average, it doesn't matter, because you can make the most out of the spousal benefit. It's just a part of the planning that we do. So I hope this episode of the Retirement Made Easy podcast has been helpful. This probably set a record for the longest podcast we've ever had, but hopefully it was fun, it was enlightening, and you learned a thing or two. I'll see you next time, and remember, always dream big.
Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. The content in this material does not necessarily reflect the views of LPL Financial. This is a hypothetical example and is not representative of any specific situation. Your results will vary. The hypothetical rates of return used do not reflect the deduction of fees and charges inherent to investing. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments might be appropriate for you, please consult your attorney, tax advisor, or financial planner prior to investing. This is a hypothetical example and is not representative of any specific investment. Your results may vary. All performance referenced is historical and is no guarantee of future results. All indices mentioned are unmanaged and may not be invested into directly. There is no guarantee that a diversified portfolio will enhance your overall returns or outperform a non-diversified portfolio. Diversification does not protect completely against market risk. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor. Fixed and variable annuities are suitable for long-term investing, such as retirement investing. Gains from tax-deferred investments are taxed as ordinary income upon withdrawal. Guarantees are based on the claims paying ability of the issuing company. Withdrawals made prior to age 59 and a half are subject to a 10% IRS penalty tax, and surrender charges may apply. Variable annuities are subject to market risk and may lose value. Riders are additional guarantee options that are available to an annuity or life insurance contract holder. While some riders are part of an existing contract, many others may carry additional fees, charges, and restrictions, and the policyholder should review their contract before purchasing. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor. Retire Strong Financial Advisors and LPL Financial are not endorsed by or affiliated with the United States Social Security Administration or any government agency. Retire Strong Financial Advisors and LPL Financial are not endorsed by or affiliated with the U.S. Centers for Medicare and Medicaid Services or any government agency.
Thank you for listening to the show today. Check us out at our website, retirementmadeeasypodcast.com. And if you want some help from Greg, submit your questions at the bottom of the page or sign up for a 30-minute retirement coaching session with Greg. We'll see you next week.